Hello, everyone, and thank you. All you smart women, we want you to get savvy with your money. And this is a very, very important topic that we are going to be talking about right now because no matter what time of the year it is, you need to be very, very updated and knowledgeable about what the tax planning. And since this is an early part, not February of 2024, you need to be prepared for 2023. And so we have a great, great speaker, Kisha, who is a phenomenal CPA, also CFP. She has phenomenal background and is going to give you the appropriate steps to get prepared for your 2023 taxes, but also will give you some insight about what you need to know about 2024. So, Kisha, thank you for spending time because I know you are super busy doing taxes right now. So, turn it over to you quickly.
All right. Thank you so much, Rene. And I'm happy to be a part of this segment. And hopefully this will be informational and useful to your clients. I titled this discussion a tax planning discussion, reflections while and after filing your 2023 returns. I'd like to say that when it comes to working with clients, I really like to make sure that we are always looking for planning first so that we're in a position where we are being proactive instead of being reactive. This slide just gives a bit of a bio about me. My firm is based in DC. It's called K Ward & Co. You can read this at your leisure at another time, but this is just a bio for those that are interested. As I mentioned, we're going to be talking about just being more proactive instead of reactive. And so the quote here is, by failing to prepare, you are preparing to fail. Thank you, Benjamin Franklin. All right. So at this point, you are probably in the process of filing your 2023 returns, or maybe you've already done it. And so at this point, we're kind of in a reactive state. So when is it kind of, start off with just summarizing or just going over 2023? So some of the things that may have come up, some of the changes that could have happened. Did you have a new baby in 2023? A big thing that I see with clients sometimes is whether or not you changed jobs in 2023. And that can impact you in a good way in some cases, and maybe not so good in other cases. So in a good way, maybe you have excess FICA withheld. And so if your Social Security wages were over 160,200 in 2023 and you changed jobs, then you're going to get more than one W-2. That's going to have FICA withheld from that, from a Social Security tax withheld from that. And in that, if you exceeded that amount with the second job, that'll actually be refunded to you. So that's a good change. But the other thing that happens sometimes is maybe you had an excess 401k contribution. I've seen that happen a lot of times. You change jobs, you're a high income earner, you're very focused on your retirement, and you've maxed out both plans. Now that's bad because when you file your returns, this will pose a problem. And you'll have to, if you found that out right away, you would need to contact your HR personnel and have them correct your W-2 to, at least for one of them, to put the money back, which would mean that they would have to correct your W-2. Now, and if you do this by April 15th, you should be okay. You'll have higher wages, but otherwise it'll all kind of be corrected and you will not have withheld for your 401k. Now, and if you don't do this by April 15th, you have an issue because you are on the hook for the taxes, for the additional taxes from that deferral for 2023, but you'll also have to pick it up in 2024. And if you're under 59 and a half, you're going to also have to deal with a 10% penalty. So if you haven't done your returns yet, if you know that you've changed jobs, first thing, fix that as soon as possible. It could take several weeks for your HR department to fix it. So I would advise to do that right away. Moving on, did you start a new business in 2023? This could have huge tax implications. even for the most studious or the most organized of business owners, maybe you didn't pay estimated tax payments, but maybe you put the money to the side. But again, we're reacting at this point to 2023. Another thing that I see, did you receive any significant bonuses in 2023? Uh, Large bonuses are welcomed and wonderful. I'm sure everyone is happy to receive those. The thing is, sometimes the supplemental withholding rate is only 22%. So if you're a really high income earner, and maybe you're in the 37% tax bracket, and the bonus was only withheld at 22%, it's possible, and this could explain for some of you who've already filed your returns, it's possible that you have a big tax bill for 2023 because of that supplemental rate when it came to your bonuses or exercises or RSUs or things like that. Also, did you have significant capital gains in 2023? Again, we're in kind of in a reactive state. And so again, if you prepared your returns already and you're wondering why your tax bill is higher than you would have anticipated, these are some of the things that could have happened. Or as I say, was there other income or a combination of things? A lot of these things can happen in the same year, and it causes a lot of changes, some good, some challenging on your tax returns. One item I left off the list I wanted to give a little bit more time to is in 2023, did you get married? So all is fair in love and taxes. Someone said that. And the question that comes up sometimes is, should you file jointly or separately? And the answer is it depends. If you're both high income tax earners, it may not really matter, but it just depends on your situation. And I'll say this towards the end or at the end of the presentation, but whatever your situation is, you should have someone look at your situation specifically. But there are some things that you may want to consider if you're going to file jointly or separately. Some things that you should know. Both of you must itemize or take the standard deduction. Whatever one does, even if it harms the other one has to do. So that's a discussion, no matter how you file, that you should discuss. And let me back up for a second. No, you cannot file as single if you are married. It is either married filing jointly or separately if you are a married couple that is married, not going through a divorce or anything like that. Those rules are different. Something else to note, your capital losses, if there's a capital loss, you would typically be able to deduct up to $3,000 of that loss on your tax returns. If you are filing separately, that loss is limited to only $1,500 and you would continue to carry that forward. Something else to note, to consider, if you have a mortgage on your property, the mortgage interest is typically limited on the first $750,000 of mortgage proceeds. If you're filing separately, it's actually $375,000. So again, something to consider when you're filing separately and something that should be considered in that analysis. If you're a business owner and in the past you were able to benefit from the qualified business income deduction, and now you're married, if you're married filing jointly, your taxable income limit, and I'm talking about service businesses that have to deal with these types of limitations because you are not, you're a service business, and so you have this type of taxable income limitation. It's $364,200 if you're married filing jointly, but if you file separately, that goes down to $181,100. Again, something else to think about. If you have children and you want to consider some of the dependent care benefits to get the credit, or maybe to reduce your wages because you've had some of that withheld from your wages, you cannot take dependent care benefits from a tax perspective if you're filing separately. So again, there could be some other things, but I wanted to point out some of the more common things that I see when it comes to filing jointly or separately. And again, everyone's situation is different. And so you need to figure out with your tax advisor, what is the best filing status for you. So other than changes in income, this is kind of a quick review on just deductions in general. So currently you have, if you're going to itemize, you're going to have either home mortgage interest, which we've talked about a little bit, State and local taxes, which would include your real estate taxes, your personal property taxes, your income tax deductions from your withholding, or if you made estimated tax payments to a state, your gifts to charity, medical and dental expenses, which would have to exceed a certain AGI limit, but that's what's available. And what this was a cute pictorial, but it was missing something. So I made a note at the bottom about investment interest expense if you've had investment interest expense. So for 2023, if you're filing jointly, your standard deduction for the year is $27,700. And these are pretty generous in comparison to prior years. And so if you're not able to itemize, you're still getting a healthy deduction. We talked a little bit about if you're going to file jointly versus separately. And if you file separately, or if you're single, your standard deduction is $13,850. If you're head of household, your standard deduction is $20,800. And there's some extra deductions if you're over 65. If you're married filing joint, it's $1,500. And if you are blind as well, it would be $3,000. If you are single or head of household, it's an additional $1,850. And so when it comes to standard versus itemized deductions, the idea is whatever gives you the largest deduction is what you would take. Again, for our married folks, if one itemizes, then the other one has to itemize. If one takes the standard deduction, the other has to take the standard deduction. A quick note about deducting mortgage interest and taxes. Just to kind of reiterate what I've already said, you have up to $750,000 of mortgage proceeds to consider for your deductible mortgage interest, unless you're grandfathered in, and that would have been before, I believe, December of 2017, where you would still be able to use the $1 million limit. When it comes to state and local tax deductions, and that's your real estate taxes, your personal property taxes, your state income taxes that were withheld, or your state estimated tax payments, that total deduction for federal purposes is $10,000. Depending on what state you live in, you could probably take it, or you may be able to take some of those additional real estate taxes, personal property taxes on your state returns, but not the income tax deduction as an itemized deduction. All right, so we talked a little bit about 2023. Some of you all may have already filed, or maybe you're upset that, okay, maybe you're in a reactive state. You weren't able to do a lot of planning for 2023, but what are we going to do for 2024? It's a new year. We can try. It's still early in the year. There are changes that can be made. First, I'd say update your filing status. Again, that's for your married folks. If you are two high income earners, I would not select married filing jointly. There should be an option to choose married but withhold as single. And so if you're very high income earners, I would consider that status, as well as any kind of tax planning to determine the actual amount that you should have withheld. You can revise your withholding up or down at this point. Maybe if you filed your 2023 returns, you had a huge refund and you would prefer to have more in your paycheck every month, then this would be the time to consider that. Or if you were under withheld, or as I mentioned before, when it came to bonuses, it's a good idea to make those adjustments right now to your withholding. You can correct or revise any retirement plan contributions at this point. Maybe as in terms of tax planning, the more that you contribute to your retirement, your pre-tax retirement plans, like your 401k, that reduces your taxable wages. And so that would be something to consider. What else is new in 2024? Are you going to have a significant transaction? What quarter is it going to happen in? Are you starting a new business? You would consider all of these things right now to determine if there should be some changes made for tax year 2024. And if after filing your returns, and maybe you're a business owner or you have significant portfolio transactions that would give you interest and dividends and capital gains, maybe you should consider whether you should make estimated tax payments. Some of the common tax issues and some things I've already brought up was if you are an employee and you are awarded bonuses or other types of rewards. Once again, if you can, you should be able, if you can, contact your HR or payroll department and ask them to withhold a larger amount when you receive those awards, and so that you're not in a position where you're going to end up paying a lot more tax. Even if you've filled out zeros for your W-4 and your state payroll withholding forms, for the state part, it's not as much of an issue as really on the federal side. On the federal side, the statutory rate is only 22%. And so if you are able to adjust that withholding, I would ask HR to do so. If you're a new business owner or a business owners in general, if your income is looking similar to what it did last year and you had a tax balance due and maybe had some underpayment penalties, at this point, you definitely want to consider estimated tax payments to reduce those underpayment penalties. If it's about the same as in 2023, if you're thinking that 2024 is going to look similar, then you would make those payments based on 2024. If you think 2024 is going to be lower, then you would make those payments based on your 2023 returns. Let me back up. I think I may have said that backwards. If you think that your tax year 2024 is going to be similar to 2023 or lower, and not too much lower, I would still use the safe harbor and use the 2023 liability to make estimated tax payments. If you think that 2024 is going to be higher because you're only required to pay in the lesser of the current year liability, 90% of the current liability, or 110%, assuming your AGI is over a certain portion of the prior year liability. And so pay in the least amount possible and put the cash towards the side. I say business owners, employees, sort of, because maybe you have a W-2 where you're an employee, but maybe you've also started a business as well. So you're somewhere in between. Sometimes this can get you in trouble because you think that you have some withholding, but it's not sufficient enough. So take a good look with your tax planner, your tax advisor, your financial planner to determine if your withholding is enough for the year or if you should make estimated tax payments. Same for our investors, where if you have, again, that portfolio income that does not have any withholding related to it, you have to make estimated tax payments, which should also include the surtax on net investment income. So that's an additional 3.9%. Or again, there could be a combination of all of these things that should be considered. And the earlier you take a look at it, the more you can kind of get ahead of it and limit any unnecessary payments or at least underpayment penalties when you file your returns next year. The other things that you would consider when it comes to planning for the year, we've talked about some income, but for deductions, there's charitable giving. And so if you're charitably inclined, and I wouldn't, you can do what you want to do when it comes to deductions, but if you're already charitably inclined, and this is going to be a big income tax year or income year for you, you might want to consider making larger charitable contributions. And I thought this was a cute chart. Some of the amounts when it comes to the standard deduction are a little dated, but I really like the chart. And so you can bunch your charitable giving. If you're giving a certain amount every year, but you're going to have a high income year for 2024, maybe make all of those payments in 2024 so that you can get the biggest bang for the buck when it comes to having a deduction to go against your income for the year. Let's say you make contributions to your alma mater, you make an annual amount of maybe $5,000, or you made a pledge. If you can make $20,000 in this example or something more significant, that will be helpful. A lot of folks like to use donor advised funds as well, because in the year that you make the contribution to the donor advised fund, you get the deduction in that year. And so if you wanted the donor advised fund to pay out a little later or over a couple of years, you can do so, but you would still get the deduction in the year that you made the contribution to the donor advised fund. Something else to consider is tax loss harvesting. And so if it makes sense, and this is why it's very important to have comprehensive financial planning, if it makes sense overall to sell some of your assets that are at a loss, and from an investment standpoint, it appears that it's not going to be much better. If you have capital gains that year, you can offset those gains with some losses. And so you would look to do that. Most of the time, this happens later in the year because the market is moving all year long. And so towards the end of the year, if there's still some losses that are available, and from an investment standpoint, it makes sense to unload those assets, you can realize those losses and help to offset some of the gains. Some other planning tips for my business owners: if you're S Corp owner or you're in control of the wages, you can give yourself a bonus at the end of the year. You can decide from an income and expense recognition perspective if you want to bill maybe at the end of December if you're a cash basis taxpayer, so that you don't receive the income until the following tax year if you're trying to move things out. Or maybe you want to recognize the income in 2024. There are just things to kind of consider as business owners, what to do with your income to kind of either lower it or increase it for things that you want to do. Again, as I mentioned earlier, maximizing retirement plan contributions is always an easy step to adjusting your tax liabilities. You can play the game of brackets if there's something happening in 2024. As I've mentioned, if this is a huge tax year for you and you want to bring down that income with some charitable contributions, you can do that. For those that have done Roth conversions and taxable Roth conversions, if there's some losses that year, maybe you only convert the amount to kind of offset that loss. And so you can kind of just play to kind of stay in the tax bracket that you feel most comfortable in. I've already mentioned charitable planning. And sometimes with all the planning that's there, you just have to bite the bullet and pay the tax. And so it would be a good idea to run a projection to see what your taxes are going to be for tax year 2024. But it's better to know earlier than to know in April of 2025 what your tax liability is going to be. So if you know there's a big tax year, you've done all the tax planning that you can, you do some year-end tax planning just to get an idea of what cash you need to have available when you file your returns. I get asked the question sometimes what to look for in a tax planning professional. And as we're thinking about just being smart with our money and just being and just understanding who makes the best team, you want a skilled person, someone that continues to strengthen their craft. I say enjoy the game because it's exciting to kind of put all the pieces together. And so just make sure that you have a great team with you. You have a strong financial planner. You want to have a tax planner, estate planner, everyone that's kind of working together to make sure that you achieve your goals. And with that, that's the end of my presentation. I hope this was helpful and to help have great conversations when it comes to your tax planning for 2024. Back to you, Rene.
Thank you so much, Kisha. That was fantastic. And I hope all of you all took some great notes and be able to reach out to Kisha on that, as well as our Smart Women Savvy Money group here at Urban Wealth Management. All right. Thank you so much, everyone. And I hope that for 2023, you're set up properly, and definitely for 2024 as well. So with that said, get ready for your taxes, because this is an important step. And these notes that you got were important.